All right, Hewlett Packard Enterprise out this week with much better than expected quarterly earnings as corporations pick up their return to office spending. The computing giant also lifted its full-year profit outlook despite the uncertainties surrounding the chip shortage. Joining us now is HPE's CFO, Tarek Robbiati. Tarek, good to see you this morning. You're calling out really strength in really companies spending more to support their return to office life. How would you grade that strength right now?
Good morning, Brian. Thanks for having me. Great question. So we see very strong demand across the board, across all our lines of business, whether it's our Edge, Aruba business, our storage business, our high-performance compute, and server business. Demand is across the board. I think it's pretty strong in terms of lines of business, but also geographies. We see the demand to be sustained and a pretty long runway ahead of us. Partly, it has to do with the fact that companies have now learned the lesson post the COVID pandemic that they need to fundamentally change their business model. And digital transformation takes a different shape in the circumstance. It's not just about automating the basics of a business, but it's much more about fundamentally rethinking the business model in a way that makes it more resilient to withstand shocks like the ones we've seen during the pandemic. So demand is pretty strong, and we feel that that runway ahead of us is pretty long too.
Perhaps you can clear this up for us. I talked to some folks on the sell side that cover HP, and they called out some concerns about second half free cash flow. What investments are you making in the second half of this year?
Yeah, no, look, first of all, it's important to note that we posted record free cash flow in the first half. So we finished the first half with $931 million of free cash flow. Our original guidance for the full year that we gave in October 2020 for the full year 21 was $900 to $1 billion of free cash flow. We've upped the guidance twice now, and we are feeling very comfortable that we will post for the full year $1.2 to $1.5 billion of free cash flow. That's a $350 million increase relative to the guidance we gave 6 months ago. And what is happening between half on half is that we had a very strong first half where we emerged out of the pandemic with a much leaner cost structure. We also have made, in the latter part of the first half, substantial investments to buffer inventory. We do see the demand picking up strongly, like I said before. We buffered up inventory. Inventory went up by about $600 million for us. And that buffering of inventory is to cater for supply shortages that we see in some of the components that we need to manufacture our solutions. In saying that, we did see that shortage of supply coming. And we said that at the end of the first quarter earnings call. We said that we didn't have any issues short term. We were well equipped and we were solving for the second half of the year. We're still working through that, but the demand continues to rise, and this is something that we need to watch. I'm very comfortable about our outlook, and our outlook, whether it is looked at on an EPS basis or free cash flow basis, factors in any sort of uncertainty pertaining to supply.
I want to ask a little bit also about that ad as a service part of the business you guys called out there. Revenue growth, I think 30% in the quarter for that part. How are you thinking about how large a segment, how large a proportion, I guess I should say, of the overall top line comes from that part of the business, as again that is growing faster than the overall company?
Yes, look, this is the epicenter of our strategy. 2 years ago, Antonio Neri, our CEO, and myself said, the world is going to be hybrid and we're going to move to a world that will not just be witnessing workloads solely taking place in the cloud. Yes, the cloud is there to stay, but it's an experience. It's not a destination. What most enterprises are realizing is that the cloud is actually very expensive, and there is all sorts of side effects, such as loss of sovereignty over the data, performance issues, and cost issues, like I said a second ago. And what they want is that experience of the cloud to be on their premises. And that's where we come in. We are enabling with our GreenLake as a service offering a cloud-like experience on premises of our enterprise customers. And it's going extremely well because at the end of the day, we're giving customers what they need. We give them the experience with control over the data. Data is going to be, for the next decade or so, the most precious asset that any company has, and they need to have that under their control. So our as-a-service offering has been doing extremely well. We've been growing consistently 30% quarter after quarter for the past 9 quarters now, and it's going to continue to do so. And we have put the guidance on our as-a-service business of a 30 to 40% compounded annual growth rate for the next 3 years. We keep shifting forward the 3-year window because this trend is very, very powerful, and we don't see that trend relenting anytime soon.
And Tarek, quickly before we let you go, you didn't pull any punches on the conference call, on the earnings call about valuations in the tech space. You called them exuberant. Does that prevent you from making a big acquisition this year?
Yeah, it's true. I did call the valuations in the tech space exuberant, but that applies to some subsectors of the tech space. I think software valuations are overinflated. They're very frothy right now. And overall, the market overvalues growth and undervalues cash. We generate a copious amount of cash, and we feel that right now there is that side of the equation is overlooked by investors who are really prepared to pay levels of premiums for growth that, in my mind, don't gel with my math. Anyway, it is what it is. We feel that there is a great need to be very disciplined in the way you conduct M&A acquisitions moving forward. We'll always have been. And we look at it from a pure fundamental view. We look at acquisitions on a free cash flow multiple basis and the prospects of companies who are not yet mature to generate free cash flow pretty soon. And we will look at acquisitions very, very selectively. We have a very disciplined approach towards this. We did do a pretty interesting number of acquisitions in the recent past. Less than a year ago, we acquired a company called Silver Peak, which we merged in our Aruba Edge business. It's an SD-WAN provider, and it's proven to be a fabulous bet because Silver Peak is growing and very, very well within Aruba. Aruba, our Edge business, grew 17% year over year, and there is an incredible demand for our Aruba services and also Silver Peak within Aruba. So we will continue to look at acquisitions, but you got to be selective because valuations are frothy.
Well said. We'll leave it there. HPE CFO Tarek Robbiati, good to see you.